Doing business in Africa. You can't afford to be without Africa Investor.
I think to start off, when you look at our clients, and there are two unique things about our client base. Like many people here, the clients are very large. And I think what's unique in terms of our client base, who we make these pitches to, is they are invested primarily in developing frontier and emerging markets. So these are people who have actually put money in, and they are institutions. And ultimately, when they're looking at strategies, they have liabilities which they need to meet, and as a consequence, that's really what they're investing for. So what I'd like to do then is just say that the challenges in that area, well, there's been one primary challenge over the last 15 years, and you've all had to deal with it. That's a strong dollar and a weak everything else. And so when all these institutions are contemplating investing, guess what they do? They look over their shoulder, and by the way, it's horrible, and they say, no, I'm not going there. Okay, so let me just talk about why these investors, these particular investors, have actually invested. So the first thing to note is, and I'm just going to use Africa as an example, if I may, because that's always the contentious continent. So if you look at Africa, what's been really interesting on the fixed interest side, and that's or fixed income, and that's a very broad category, actually the performance of that category, and that's quite an important difference between the way I would look at this and maybe some of my colleagues here, is that when you look at the portfolios, the beta has been so good. And if it's been diversified, the alpha, which has been choppy, the alpha being your extraordinary returns, can go either way. But if you have a diversified portfolio and you recognize that, let's say, risk can be priced, sold, avoided, or by the way, pooled. When you're pooling these things, you're getting rid of that risk. And when you look at that portfolio, it's actually done very well. And it's done extremely well. So that part of the African story has actually been very good. And it's easy to look over your shoulder and forwards, given how high yields are now, to actually say this is going to carry on doing well as long as you have a well-diversified portfolio. So I'm not going to worry about that. The second area where people are far more let's say, concerned is equity. And I just want to give you what has been positive for us in recognizing Africa in equity is we have, let's just say, a unlisted private equity portfolio, and so it's unlisted, and it's across a variety of countries and companies. To the extent of about 150. So it's actually quite a diversified portfolio. What's interesting is if you look at the vintages going out 10 years, the earnings growth. Now remember, when you're running companies or you're looking at companies, and many people here are CFA charters, the earnings, and Benjamin Graham will tell you this, are really what drives company returns. So if you look at the earnings growth, what's really interesting there is over the last 10 years, the earnings growth on this specific portfolio is the same as the earnings growth on the NASDAQ, 10% odd in dollars. And by the way, and it matches the Russell 3000. You can actually just pull this off a Bloomberg. So you can go and look at the earnings yield, take out price, and just see what the growth is. So what's interesting there is then you would say, okay, well, the performance should be the same. And no, it hasn't. The NASDAQ has had a multiple which has shot through the roof. The Russell 3000 has had a multiple which has been pretty flat over that period. And Africa has gone down. So same kind of earnings stream, but when you look over your shoulder, no one wants to touch it, not because of the quality of the companies, but because of the multiples and the ratings. Now, here's where it gets interesting. Over the last 3 years, I'm just going to skip a whole lot of analysis, but over the last 3 years, the earnings growth of that portfolio has been 31%. It's a diversified portfolio, whereas the Russell and NASDAQ have been closer to the 10% level. But which one has outperformed? Okay, in this case, when you start to get to flat multiples, you start to actually see that the earnings growth is so high that the performance comes through. And that's what you're seeing. So you're seeing IRRs on that unlisted portfolio of 30%. Now, this doesn't sit comfortably with any of you on your view of Africa. Why? Because no one's close enough to the data that should be measured. But when you have the data and you look at the data, it's looking spectacularly. And those longer term assumptions really are where there's a problem. Now, in us pitching to these asset owners, and I'm sorry I'm going on a little bit, just one more point to make, is we have to look at their we have to look at their liabilities. So what you can do is it's just an actuarial assumption, or a whole lot of actuarial assumptions. And what you can do is you can so there's scheme rules and inflation. You build all this thing in and you get an 80-year cash flow stream. What you can do is you can price that. So we then go and do that, and then we optimize that against all assets available in what's known as an asset liability model, which many of you will know. And it's based on market principles. So what that means is this is all forward-looking. When you look at that, and I just want you to know that when we put in Africa, and the same is true with emerging markets, et cetera, but just dealing with Africa, we hold a gun to the model's head in that the risk that we're using is 45%. Now, for those of you that know modeling, on a 12-month basis, that is pretty insane. It's pretty much like dealing with the gold market. When you do that, what's really interesting is people sometimes forget that portfolios are amazing things. You can take something high risk, add it to something low risk, take 2% of this and add it to this. And what happens to the risk of that new portfolio? It goes down. So when you do these calculations, it turns out that for very, very reasonable American members of pension funds, and by the way, pensioners, for a wide range of risks, you have this 1%, 2%, 3% of Africa creeping in. When you say, look, I'm not cared about risk, I just want return, then by the way, it kicks into Africa and it kicks into emerging markets and all other stuff. But if you just, on a model, and you look for from 0 to 15%, you have this thin sliver. Now, in terms of what you're saying, Hubert, is that 2% or 1% of all American portfolios, if in an optimal portfolio sense you put in Africa, I'm not sure we'd be having this discussion here right now. And so it's a really interesting thing, but people aren't doing the work, and the work is not being done because we all focus on the investment. But that's not really, you want the beta of the investment. You want to take out the excess risk. You hire very good specialists to do that. You use blended finance. All of these things are really good tricks as long as you get a diversified portfolio, because then it actually comes through quite nicely. And that's the important thing, is to look realistically backwards and see what's actually happening, and then make sure that you're pooling in your portfolios to get the right risk dynamics within a total portfolio framework as opposed to one asset.
Doing business in Africa, you can't afford to be without Africa Investor.